Good morning, good afternoon, good evening, wherever you are in the world, and welcome, if my maths doesn't fail me, to episode 22 of the ESG Show. Today we're talking about the business case for ESG, and I actually think it's a very important topic because we get a lot of negativity about ESG. People talk, oh, it's all cost, but actually there's an opportunity in it as well. So we're looking at the business case for ESG today. Before we get into that, I want to talk to you about a survey that we did. And we asked the question, which of these books on ESG do you think help you learn more and understand its issues and how to act authentically? And the answer came back that the two most popular books of the four options, or the three options that we gave, were the ESG Factor and the ESG Essentials, both of which got 38% of the vote. And then the new Sustainability Frontier got 25% of the vote. Now, I often get asked that question, actually, by people. Can you recommend any books? That's one of the reasons why we ran this survey. So please, if there are any other books that you would recommend, please include them in the comment section. I know for a fact that there are a number of people who are interested in that question. I hope that they're looking at today's show. So let's move on now and meet today's guests. And on the show today, we have Carlota. You're going to have to help me with the pronunciation, I'm afraid, Carlota. Carlota, I'll let you introduce yourself.
Ochoa, Neven.
Thank you very much. How are you today?
Very good, thanks.
Good. So Carlota is a principal at the deep carbonisation fund, Extantia Capital. Leading UK deal flow. She started her career in European energy and carbon markets at Merrill Lynch before moving into the tech sector. Here she led the production team at the early stage food delivery startup and later worked in big tech, running part of Amazon's consumer electronics business in the UK. Carlota moved into VC whilst completing an MBA at the London Business School, initially focused on B2B software and then moving into climate tech with Extantia after multiple angel investments and advisory roles in the sector. So where are you today, Carlota?
I am in London. Presumably not too far from you.
Not that far from me. And an hour and a half by train from me. So on the Extantia Capital website, it says, we back daring entrepreneurs whose breakthrough ventures can significantly reduce emissions and accelerate the transition to a decarbonised society. Could you be one of them? Let's find out. So what I'm interested in though, Carlota, is what advice do you have for an entrepreneur wanting your backing?
So I think the most, I'm not going to talk about what we look for in founding teams, similar what you'd expect other VC funds to look for in terms of a strong team, a mixture of scientific and commercial aptitudes. But I think what's more specific to us than that's not that specific to other funds is that we need to clearly understand the positive impact that the companies that we invest into can have. Now we frame it because our mandate as being a deep decarbonization fund. So on the ESG side, we're more focused on the E. So we want to see that there's a pathway for the technologies that we back to reduce 100 megatons of greenhouse gas emissions per year in the long run. So a founder would kind of have to be able to say to a certain degree of confidence, yes, we can achieve that impact, and this is how we do it. And if not, if they don't have that answer ready, then the first question from us will be, well, let us know what those numbers are, and then we can figure out whether it's worthwhile to continue the conversation.
Okay, thank you for that. So we'll be talking to Carlota again in a few minutes. Also on the show today is a returning guest, Giorgio Castro, who's a professional consultant at Geosyntec. Hello, Giorgio. How are you?
Hello, Michael. I'm good. Glad to be here.
Good. And where are you today?
So I'm based out of Atlanta, Georgia, in the US. So it's early morning for me.
Right. Okay. Well, it's a nice civilized 1 in the afternoon here in Britain. So Sorry to get you up early. He has a BSc in economics and an MSc in sustainability finance from Maastricht University. He's a certified sustainability and climate risk professional by GARP. He has 6 years of postgraduate experience in financial analysis and financial modelling. So Giorgio, can you tell us a little bit more about what? Oh, I beg your pardon. I missed a bit out. George's previous work experience includes GE and Citi. Can you briefly tell us what Geosystems does? And since you've been on the show before, maybe you could tell us, has anything exciting happened recently?
Absolutely. Well, first of all, it is a pleasure to be here once again and join you and the other excellent speakers in today's episode. At Geosyntec, we help our clients navigate the complexities of the ESG world. No matter where our clients are in the world, our local and international experts help in meeting client sustainability goals. Since I last joined the show, we continued our effort in the public and private sector, conducting various climate risk assessments and developing preparedness plans. We're also continuing our efforts in growing our solid waste advisory practice, as more companies and municipalities, often pushed by regulators across the US, are striving towards waste reduction strategies and diversion from landfills, as well as exploring emerging technologies in the renewable energy generation space, which involve landfill gas and anaerobic digestion technology.
Okay, thank you for that, Giorgio. And speak to you again in a few minutes. And also on the show today, we have a returning guest, Dr. Raj Ghosh, who's been on the show twice before. Hello, Raj. Hello, Dr. Raj. How are you? And where are you calling from today?
Hi, Michael. Hey, everyone on the show. It's nice to be back again. So I am based in East India at the moment. So I'm streaming from there.
Okay, thank you for that. A little bit interference there, but I think it was fairly clear what you said. Dr. Biswaraj Ghosh is an award-winning sustainability ESG strategy consultant, advising clients on sustainable solutions in ESG risk disclosure, governance, climate and decarbonisation with over 10 years of experience. He has held several roles at the University of Nottingham and Nottingham Trent University, UK, including that of researcher, co-author, PhD scholar and sustainability lecturer. He also served as a visiting scholar at the University of Kassel, Germany, and as a researcher at the University of Derby. As a Parlia mentor, he delivered a social integration project under the guidance of a serving British MP. He's also a mentor to aspiring students and professionals entering the sustainability space. Dr. Raj has also published book chapters and articles on management controls of sustainable in several journals. His latest co-authored publication on the topic of sustainable management was released. I beg your pardon. It says here will be released, but that's because it's an old bio. Was released in August. In Raj's free time, he enjoys cooking, traveling, gardening, and photography. So, to Dr. Raj, I'm always interested in the Indian perspective on ESG. How important a topic is ESG in India?
Sure. Yeah, so a lot is actually happening in India in terms of ESG. I will share a few points with you to validate my statement. So let's begin with the educational sphere. So we are seeing more universities in India incorporating sustainability related modules as part of the academic curriculum. From the regulatory government standpoint, a lot of changes are being introduced by the government of India, like the Green Credit, Green Finance Initiative, EV policy, net zero transition goals, etc. We have the regularized BRSR requirement that the top 1,000 companies have to focus on in terms of their reporting engagements. The 2% CSR contribution rule is already there. We are also seeing more and more Indian companies recruiting for CSR sustainability roles that was not as intense as 7 years or 8 years ago. I see plenty of individuals on LinkedIn doing degrees on energy management and environmental engineering from Indian universities. And as my role as a consulting manager, we are receiving a big interest from companies based in India on TCFD and climate risk assessment. So I think a lot is happening in India, and most Indian states and some cities have already introduced climate action plans. For example, Ahmedabad is one of the few cities to have its own heat action plan in Asia. And just yesterday, I read a news somewhere the central Indian government will introduce the requirement of the use of recycled waste materials for road construction. And then there is another bit of news about hydrogen-driven automobiles going on trials in Indian market. And India is already witnessing a EV revolution, with Kolkata leading the EV public utility vehicle segment. India has also developed its own green building council, and as part of the mission Lifestyle for Environment, the Indian government unveiled a list of 75 lifestyle practices that can promote climate friendly behavior. These actions include saving energy, water, reduced use of single use plastic, sustainable food systems, waste reduction, healthy lifestyle, e waste handling, and so on. And there is a growing market for EPR, extended producer responsibility guidelines, also that is unveiled from the government. So, yeah, in a brief, there is a lot that is happening in terms of ESG in India.
Okay, thank you for that. That's good. That's good to hear. And indeed, we have a lot of the viewers of the show are from India. I estimate that around about 25% of the people who watch this show are from India. So that's encouraging. Okay, so now we reach that part of the show when we have a look at recent editorial articles, and for that, Giorgio and Carlota will be joining us again. And the first article we wanted to look at is an article, ESG Opportunities Unfolding on the Back of Sustainable Finance. That was it on consultancyme.com. So, Giorgio, what's all this about?
First of all, this article caught my eye because my bachelor thesis was about Islamic finance and my master thesis was about sustainable finance. So this kind of merged the two. Well, according to the authors, Philip Lambert and Yahya Nuti, the efforts in sustainable finance in the GCC countries in that region are paying off, and at the same time are paving the way for related ESG opportunities. The article underscores the synergy between sustainable finance and ESG opportunities in the Gulf countries, reflecting a substantial commitment to align with the global sustainable development goals. By taking a lead role in sustainable finance, these nations can assert themselves as influential contributors to the international policy forums such as Net Zero Agenda. And this shift has the potential to guide towards a cleaner and more diversified economy in countries that historically have been known to be oil producers. Additionally, the integration of Islamic finance principles into sustainable finance is a strategic step that enhances the credibility of Islamic finance offerings and taps into a market of ethically minded investors. And by emphasizing transparency and accountability in financial decisions, these countries are becoming more attractive to responsible investors and positioning themselves as destination for sustainable investments. The emphasis on sustainable finance also empowers private businesses to adopt sustainability models, reducing environmental footprints and elevating social impact, ultimately enhancing brand reputation and value, which for this country's history is very important. Well, overall, the GCC's focus on sustainable finance and ESG opportunities represents a proactive and strategic approach that aligns with global sustainability goals and has the potential to greatly impact the region's development and leadership in sustainable initiatives.
Okay, thank you for that, Giorgio. We're also looking at another piece. Money managers are shifting their attitude to ESG as realism sets in, says S&P's Dan Yergin. Carlota, can you talk us through this piece?
Yeah, so I mean, I think that the crux of the argument is that there's been a lot of outflows from ESG funds over the last couple of years, as money managers are seeking returns, right? And they're just going to realize that at the end of the day, shareholders want to see returns. not just impact. I don't think that's particularly surprising. Markets are cyclical in nature. So it's no surprise that ESG funds have underperformed versus non-ESG funds, let's say, since the crisis in the Ukraine triggered an increase in fossil fuel prices. So those owners in oil and gas majors and stocks will have outperformed, triggering outflows of the alternatives. Then on top of that, you've got a pretty challenging interest rate environment, which tends to more negatively impact new projects to be built that become more costly in this environment. And these tend to be overwhelmingly renewables versus new oil and gas fossil fuel assets. So I don't think that's surprising. Markets are cyclical in nature, but I think this is a long-term gain. I don't have any doubts that low carbon technologies will outperform their polluting counterparts in the long term. And I also wouldn't be surprised to see new inflows into sustainable funds as we're nearing peak interest rates and outperformance over the last years. Underperformance over the last years means that it's a more exciting entry point and makes it just more attractive. So overall, I think I agree. I'm not surprised. But seeing outflows in response to short-term market cycles doesn't concern me, as I think we're playing the long game here.
Yeah, I mean, I'm sure. I think that's probably right. The markets, what happens in the short term and what happens in the long term are often disconnected.
Yeah, I mean, I'm sorry. I was just going to say, I'm a venture capital investor, so my time horizon is 10 years. So seeing short-term outflows because of price movements in the market isn't necessarily a concern.
Yeah, indeed. Raj, Giorgio, do you have anything to add on this sort of short-term challenges but long-term potential?
There will be challenges, but those will be easily overcome because most institutions understand their role or have started understanding their role in transition towards net zero. So finance institutions, for example, they will have their own ESG criteria to finance new projects, and we will see a lot happening in this field. For example, divestment in value eroding industries and sectors. So this will pick up. Yeah.
I think that the short-termism, it's more of a cultural thing as well. As long as companies are valued on the next quarter, especially public companies, it's difficult to shift this myopic view with the more long-term perspective. So I hope the efforts in that space, as well as in valuation tools, will be made.
Okay, well, the myopic view will shift. Well, I'm sure you're right. And then one more item that we were looking at today, and this one concerns India, and the paradigm shift brings sustainable investing opportunities. That's an ESG clarity. And who better to talk about a story about what's happening in India than Dr. Raj? So what's all this about then?
Yeah, so Michael, this is basically focusing on India's net zero commitment by 2070 and the upcoming regulations around green financing opportunities and a transition towards net zero. Hello? Hello, am I audible?
Yeah. Carry on talking. Yeah.
Okay. So the groundwork has already begun in India with more banks participating in the green finance stream. More funds are getting earmarked for ESG projects that include investments in low carbon technology. And we will see a lot happening within the stream of green finance, mainly driven by the government of India. And majority of the frontline Indian banks developing their own ESG criteria for financing new projects. So I think in the near future, there will be an increase in divestment from value eroding industries and a lot more investment in socially responsible investment funds, mutual funds, green bonds, and any new instruments that the government of India is proposing at the moment as part of its green financing scheme. So there is a lot happening, and in the next 2-3 years, there will be a lot happening in this field.
Excuse me. Thank you for that, Dr. Raj. Thank you for the bless you comment. apologies if I'm making a few sneezing and coughing sounds this morning. I think the changing in the seasons from summer to autumn, it's taking its toll on me today. So I'm now going to be having a chat with Carlota for a few minutes. So Carlota, welcome back. Not that you disappeared, but good to speak to you one-on-one. So Carlota, tell me, so traditionally, when investing in the ESG space, there's always been a trade-off between achieving impact and financial returns. Is this still the case, or has this changed when investing in climate tech?
Yes. So ultimately, as in we are in an Article 9 fund. Impact is one of our main goals, but I think we're in a kind of this unique position where there's no longer a trade-off between achieving the impact and achieving outsized financial returns. I think my thesis and our fund's broader thesis is that decarbonizing is good business. As we will see increased number of legislations, more legislations coming through, stakeholders pushing the corporates who they've invested into and whose goods to buy to adopt more sustainable practices. I just think that those corporates who decarbonize faster will benefit and will want to invest into technologies that can help them decarbonize. So I think I think doing good on climate is just good business. It's not impact investing.
Okay, thank you for that. So has the energy crisis triggered by the war in Europe changed the business case for climate change investing?
Yes, it definitely has, and I think it has so on two levels. One is relating back to probably the article that we spoke about earlier, right? So the increase in oil and gas prices has meant that there's been a resurgent kind of interest in that sector. I think that happens more at the later stages of investing and in public markets. In private markets and early stage investing, I think on the other hand, this crisis has actually given us another boost, because European governments and governments outside of Europe have realized that investing in the energy transition is no longer just a climate play, but it's also an energy security play. And renewables, unlike oil and gas, tend to be decentralized. They're not necessarily tied to where the resource is. You can have a biogas plant wherever you're generating the waste. You can have a wind farm wherever you have wind. So I just think that ultimately that kind of has made it a stronger prerogative for governments to back these type of technologies and projects. As it's not just a climate challenge they're trying to solve, but also an energy security challenge.
Okay, thank you for that, Carlota. So it's all very well investing in climate change when things are good and things are going great, but there's been a bit of a market downturn in tech investing. So how has this impacted the sentiment around climate tech?
Obviously it's affected, as in we're not decoupled from the sector as a whole, but I do think it's fairly resilient for all of the reasons that I've just highlighted below. Before. And in addition to that, there's been a lot of capital that has been allocated, as a private capital that has been allocated to the sector, but not necessarily deployed, which means that the coffers are full. People have just been holding back a little bit to spend that money and make those investments until they kind of understand where the broader market is going. So now, as we're kind of coming out of this downturn, I think we'll continue to be resilient and start seeing investments pick up again.
Okay, well, thank you for that. So we haven't discussed this before. Maybe you want to have a little bit of time to think about it, but we did a survey this week about people's favorite books in this space. Do you have any thoughts about that, or do you want to think about that and come back to me later, or any books that you think you could recommend?
I can get back to you later. Not at the top of my head. I mean, there's a lot out there. Yeah, not the top of my head. Sorry.
All right, no problem. If we've got time, we'll come back to that one a bit later. Okay, well, thank you very much, Carlota. See you again in a few minutes. Also today on the show, we've got Giorgio. Hello, nice to have you back, Giorgio. So Giorgio, many companies are increasingly focusing on ESG factors. So what does it matter for businesses beyond just being moral or ethical? I mean, there's a moral or ethical obligation, but is there a greater reason, or is there another reason, not a greater reason, but is there a more pragmatic business reason why it matters?
Right. So it's true that many companies are increasingly focusing on ESG factors, and they're recognizing that the consideration extends far beyond being mere moral or ethical obligations. In fact, ESG matters significantly to businesses for several compelling reasons. First and foremost, it is a risk management tool. If we consider the S for social factors, which includes issues like diversity, employee well-being, and community relations, if company neglects this, that can lead to workforce issues, reputational damage, and in some cases even legal troubles. And similarly, looking at the E aspect of ESG, so environmental factors, this ties back to climate risk. But we're going to see also that ignoring environmental concerns can lead to regulatory fines, it can lead to supply chain disruptions, but it can also lead to stranded assets, and they can affect ultimately the bottom line of companies. And finally, for the G portion, so the governance, that is about effective management, which can enhance financial performance and reduce the likelihood of scandal by sustaining a company's reputation. So ESG isn't just an ethical, companies are starting to realize it, and it's about long-term resilience and financial stability.
Okay, so thanks for that. So the physicist Niels Bohr once said that prediction is very difficult, especially if it's about the future. And so climate risk is a hot topic, but how can businesses quantify and manage climate-related risks effectively? And what are the potential consequences of ignoring them?
Yeah, and it's true that predicting is always the most difficult aspect. Oftentimes we say that we are transforming an uncertainty into a mistake, which helps us navigate the world, but it doesn't need to lay the future in an exact matter. Climate risk has emerged as a critical and high priority topic for businesses across various industries, and effectively quantifying and managing climate-related risk, it's imperative in today's evolving global landscape. Quantifying risk involves assessing how a company's operation and value chain are exposed to climate-related events, like extreme weather, but also transition risk like policy changes. Businesses can use scenario analysis to model different climate future, and this, let's say, helps us mitigating, trying to predict a certain type of future. And the consequence of ignoring climate risk can be significant. Ignoring them can lead to physical risk, so concrete damage to infrastructure, but also transition risks, which may involve the abrupt shift in market demands or even stranded assets in some case, which is the concept of reducing the value of an asset in light of policy changes or market demand changes. And financial markets we're seeing, and Carlota is an example of this, are increasingly factoring this climate risk in. So companies not addressing this issue may find themselves facing higher borrowing costs, reduced investor confidence, and even legal liabilities in some cases.
Okay, thank you. So ESG and sustainability reporting can be complex. How can companies effectively communicate their ESG efforts to stakeholders, and what role does transparency play in building trust? Big question, that one. Role of transparency in building trust.
Yeah, and I'll try to dissect it and answer it, because it's true that effectively communicating an organization's ESG efforts to stakeholders is a complex task that involves that involves transparency, that involves authenticity, and strategic alignment. ESG and sustainability reporting, while complex, are essential tools for building trust and demonstrating a company's commitment to responsible business practices. Companies should focus on material issues, which are those most relevant to their business and stakeholders. Regular and standardized reporting tools, such as through framework like the GRI or ASSB, can really help in navigating the complexities of it. It's also important to show progress and set meaningful targets. Transparency is key because stakeholders, from investors to customers, increasingly demand it. And trust is built when companies deliver on their ESG promises, engage in open dialogues with stakeholders, and show a continuous commitment in improving. In today's information-rich world, transparency is a cornerstone of building trust. And it's important to understand that while it used to be an aspirational target, it's now becoming a mandatory or a regulatory commitment that companies have to face.
Sorry, I started talking there. I didn't realize that I wasn't on the screen. Thank you for that, Giorgio. I asked Carlota a question, which is a bit mean because we haven't discussed it in advance. You don't have to answer it now, or you don't have to answer it, but you might want to think about it and get back to me later on the show if you possibly can. But do you have any books that you might recommend in the fields that we're discussing? You can answer now or later. It's your call.
I think a great one, it's called Grow the Pie by Professor Alex Hetmans of Imperial College London, if I'm not mistaken. And he talks about the idea of, rather than focusing on increasing the portion of ESG, we should focus on increasing the economy overall in that space, and that ultimately help in increasing the bottom line of companies in their sustainability space. I'm not giving him justice by summarizing his book like that, so can you
give me that name again? Grow the
Pie.
The time?
The pie.
Oh, the pie. I beg your pardon. I'm just looking it up. Grow the Pie. How Great Companies Deliver Both Purpose and Profit by Alex Edmonds. Is that the one you're talking about?
Correct.
Okay, thank you for that one. Grow the Pie by Alex Edmonds. Thank you, Giorgio, and see you again in a few minutes. And now I'm back with Raj, Dr. Raj. Nice to have you back. Nice to have you back again, because you've been back before. What are the business case reasons driving sustainability and climate adoptions, do you think?
Sure. So there are plenty of reasons why organizations choose to go sustainable. So these motivations include risk management, for example, safeguarding their assets against climate-related risks like heat wave, rain or river-induced floods, sea level rise, wildfire, drought, water stress, and so on. So by proactively managing the interests of diverse salient stakeholder groups, the organization who is engaging in sustainable business practices are aiming to gain legitimacy or the right to continue in the local economy that they're based in. Other motivations include shaping differentiation strategies by proactively engaging in regenerative practices. So this could be regenerative water practice, for example. And there are plenty of other reasons as well. That includes, it's a bit academic, but it includes coercive isomorphism. That is when companies are forced to comply with laws and norms around sustainable business practice. Like, for example, BRSR, or the external reporting practice in India. And then in the EU, you have your own reporting practice on sustainability and so on. There is also mimicry-related isomorphism. That is, the peers are doing it. So if the peers are engaging in business practice, so the company, the other competitor, chooses to engage in such practices so as to not fall behind competition. Then, like this, there are plenty of other reasons. These include talent attraction and retention, access to funds at a lower cost of capital, tapping into the ethical consumer base, and so on. So we touch upon some of these motivations in our recently published book, Sustainable Management, a complete guide for faculty and students. So yeah, so being sustainable may lead to cost cutting, more revenue generation capacity, increased market share, new customer bases, reduction in legal penalties, and also to gain intangible benefits like reputation and brand. So yeah, so these are some of the business case reasons of being sustainable.
Okay, thank you for that. So, does that mean you've just answered my question about recommending a book? Is that the book that you would
Um,
recommend?
Yes, so it's the same book that we have been promoting. So it's the third edition on sustainable management, a complete guide for faculty and students.
Okay.
And yeah, and we have in this book we basically focus on different topics related to sustainability and sustainable management.
Okay, so you fine. Thank you. Thank you for that. You've recommended a book for which you've written a chapter. Nothing wrong with that. I would probably do the same. So what would we be seeing more of happening? What do you think we're going to be seeing more of happening in the future, do you think? Wow.
Yeah, so we would continue to witness growth in sustainability communication. As has been pointed out before also, it increases the transparency, it makes companies accountable. So there will be a lot of increase in integrated reporting. So GRI has already grown, you can say 100% over the last decade or so, but there will be a lot more integrated reporting that will happen in the near future. There will be a growth in SBTI, so science-based target initiatives. So more companies will be focusing on that. There will be special increase in specialized reporting like CDP, where companies will talk about how they are managing water, climate, forest. So there will be a lot of increase in these areas. For example, in India, BRSR will fill sustainable reporting because it has become
Excuse me.
law now. And likewise, we will continue to see more companies engage in climate risk assessment. So companies have started valuing climate and the risks associated with climate, and they are taking proactive measures to safeguard their assets. And I know this because as a consulting manager, I see a lot of clients asking us to do their climate risk assessment, and these go until the year 2100. So basically, we are looking at what is going to happen in the near future, like 2030, 2050, 2080, and the longer term 2100. So yeah, so there will be more of these.
Okay, thank you for that. One more question, and don't be concerned if I disappear when you answer this question. Banks will play a crucial role. Your thoughts on that?
Absolutely. The role of banks is a key towards sustainable transition in India as well as in any other country. Gradually, we may see more banks divesting from sensitive industries, a movement that had started over a decade ago. So we will see more funds getting earmarked for sustainable transition. It could be in low carbon technology, clean development mechanisms, investment in socially responsible investment funds, mutual funds, green bonds, and so on. In India, we are witnessing more and more banks coming up with their own ESG criteria before deciding whether to lend funds to companies or not, so that unsustainable or value eroding companies do not receive funding. In India, green finance is receiving traction. Initiatives like green bonds, carbon pricing mechanism, and sustainable investment strategies are driving the shift towards a greener economy in India, and it will provide the platform for India's ambitious net zero proposition by 2070. And I should also mention that the government of India is proactively looking at green finance and green credit scheme in India. So there will be a lot of movement towards great green finance, green sustainable mutual funds, and ESG related funds in the near future.
Okay, well, thank you very much indeed for that. Dr. Raj. And now we're all going to recongregate. And first of all, we've had a couple of, I don't know the words questions, more observations from the audience. Martin G. Viova said about a third of the profits were driven by ESG in positive and negative terms. So ESG's been driving the profit both ways. And Eric V said integrated reporting is mandatory in EU from next January, ESRS, for 50,000 companies in the EU and 10,000 outside the EU. Okay, well, thank you for that comment, Eric. And also from Eric, do you think that insurance companies will also be a powerful lever? Any thoughts about
Absolutely.
that?
Yes, absolutely. So I'll just give a quick example. One of our clients, we have been asking them about their insurance premiums. The reason that we were asking about insurance premium is because if an asset is going to go underwater, under flood, or will be impacted in any way due to climate parameters, there will be a direct consequence on the amount of money you're going to pay the insurance company. So since the risk is going to go up, insurance companies will be in a position to charge a higher premium. So insurance companies will certainly have a role to play when it comes to climate risk management. And lower the risk, obviously, lower will be the premium, but higher the risk, the premium might go up in the future.
Okay, thank you. Anyone got anything to add to the point about insurance companies? Raj, you mentioned earlier that you see a push from the Indian government for carbon pricing. What's driving that, or do you know what's driving that?
Well, since the last 10 years, the government of India has been very proactive when it comes to sustainability. So there we have seen some laws that have come out, some norms and principles that are coming out at the moment, like at the level of the government. For example, we have the Department of Climate Change, Environment and Forests, which is a central government initiative. This department basically looks at sustainable parameters throughout the country as well as climate change, and they are the ones to basically develop climate risk assessment programs in India. So what is driving, I would say, is basically institutions. It's driven by organizations, it's driven by for-profit companies, it's driven by NGOs, and it's driven by the government, because the government itself is very proactive in this area, and they understand that climate change is a risk, and that is going to affect the future generation. So they have been proactive, and you see the outcome in the forms of new regulations like carbon pricing, like the BRSA, like green finance, like the producers, extended producers responsibility guidelines. So yeah, so it's being driven by the government.
Why are companies pushing this? They're shooting themselves in the foot, right? As in the European Union, all the companies that were under the EU ETS, they were suing the government and doing everything they can for the EU ETS to come into existence. And when they adjusted the EU ETS to limit the supply of credits, it was a huge issue for the business community. This is not as a So I guess I'm trying to understand: is it the CBAM? Is it lots of empty words?
I would say that this is more from a positive action oriented perspective. Like, it is not a reactive process. It's not a consequence of reactive actions or penalties or litigations, but this is driven through a very positive approach that there is a problem, there is a risk that is going to affect the future generation, and for this, to mitigate these risks, we have to do A, B, C, D, and D, and that's exactly what the government is doing in partnership in partnership with NGOs, in partnership with the commercial institutions in the country. So it is driven by policy, but from a very proactive approach, I would say, from a very proactive perspective, rather than it being driven reactively.
I don't know. I doubt that, but okay.
Okay, thank you for that. Okay, I have a question for you all. Incorporating ESG principles often requires significant investments and changes in business operations. How can organizations strike a balance between sustainability goals and financial viability? And what are some of the innovative approaches to funding sustainability initiatives? Giorgio, do you want to have a go? Do you want to kick off with an answer to that one?
Sure. Well, first of all, Alex Edmond is a professor at London Business School, not Imperial College London, so sorry, Alex. Anyways, incorporating ESG principles into business often necessitates a substantial investment. However, it's becoming a key strategy in recognizing that sustainability can lead to cost savings in long-term financial benefits, as Carlota was also mentioning to us before. For instance, incorporating energy efficient technologies into your practices not only reduce your carbon footprint, but also lowers your energy bills. And similarly, investment in employee well-being and diversity can ultimately enhance your productivity and innovation, which ultimately affects the bottom line positively. Other approaches to align sustainability initiatives with broader business goals are the integration of a company strategy with sustainability, rather than treating it as an isolated effort. Incorporating environmental and social factors into supply chain decision might mitigate the risk and create more resilient operations. So overall, although being a costly, at least in the first few miles, initiatives, ESG goals and financial viability needs to be thinking as a strategic tool and not a trade-off. So integrating sustainability can drive long-term financial benefits and resilience, and ultimately affect the bottom line of a company positively.
Okay, so I think what we're saying is that sustainability goals and financial viability are not mutually exclusive. Carlota, Biswaraj, have you got anything to add to those comments?
Yeah, sure. I mean, I think Giorgio nailed the hammer on the head especially on the kind of the diversity and gender balances. It's proven that leads to outperformance in the long run. Maybe just on the decarbonization piece a little bit. I think if you subscribe to the world view that we want to achieve, as in at least here in Europe, to net zero by 2050, we'll see more and more regulation to drive that, at which point companies will have no choice but to switch to greener technologies and produce things that they produce with less greenhouse gas emissions. So how do you achieve that without having negative financial consequences and increasing your marginal cost? It is invest, and this is what I'm seeing a lot, investing in early stage startups and technologies that can achieve that can in the long run and at scale produce the things that we produce today in a similar manner, but with a lower carbon footprint. The green premium, that there's a green premium attached to that today, which would have a negative consequence. So these companies are investing into these alternative technologies at the earlier stage, so that when they're ready to scale, the green premium can come down, and there is not necessarily a negative financial repercussion, right? As in prime example is if you take solar, right? Solar a couple of decades ago was extremely expensive. Now it is one of the cheapest level cost of energies that you can get. But those early investments need to be made, and the technologies have to scale and optimize to the same level as the existing polluting technologies.
So a
lot of the Sorry.
Yeah, carry on.
No, I was just going to say, so we co-invest with a lot of strategics from the industry who do so for exactly that reason.
Is there a risk? So if you've got something like solar, which has fallen so rapidly in cost, the people might turn around and say, well, we'll wait for it to fall, the cost to fall. So they wait for the cost to fall, but then as a consequence of that, it's not getting scale, and therefore the cost doesn't fall. Is there a risk there, do you think? I know that's not what's happened,
No.
But
not really. As in the industries know that they need to decarbonize, and they know that if they don't invest into the solutions, nobody else will. So it's a critical business risk for them. Which is why the investments are coming in.
Okay, I suppose it's an analogy there with computers 20 years ago.
Exactly.
A computer is going to be more powerful in 3 years.
These industries have just optimized over years and years, which is why they're cheap. And I expect the same thing to happen in the energy transition, energy transition technologies and other decarbonization technologies.
Okay, all right, thank you. Well, we're practically out of time, so let's make this a very, very quick question. I'm going to give you 30 seconds each if you feel inclined to answer it. What is the single biggest risk threatening the business case for climate positive technologies? Give you all a go at that, but I need you to be super brief, super quick, super brief. Anyone wants to have a go at answering that question? What is the single biggest risk threatening the business case for climate positive technologies?
Sure. I think it's the associated materials necessary for electrifying the world. So the rush towards lithium and other that requires mining, that requires resource, and I see that as another little gold rush that's happening at the moment that could be hinder, let's say, positive progress.
Okay, thank you.
I mean, on my side, I would say flip-flopping policy, as in such as the one that you're seeing in the UK at the moment. And then to be able to make long-term investments, people need to believe that the incentives are in place and that the regulation around that isn't going to switch and change with every incoming government.
It's interesting. I was talking to someone about the UK flip-flopping this morning, and I think that what's happened is that the government have formed the view that there's political capital in moving away from net zero, but or slowing down net zero. But I'm not convinced that they're right. I think a lot of people strongly disagree with that move. Dr. Raj, any comments to make? And I also believe you wanted to make an observation about discount. Over to you.
Yeah, so if you're in India and you are eager to buy the book, you can get in touch with me directly, and I can share the details with you, and we'll get at least a 20% discount.
Fantastic. Okay, that's great. That's great. Thank you for that, Raj. So please get in contact with Raj if you're interested in buying the book and you want to have a discount. And what about your answer to the question? What is the single biggest risk threatening the business case for climate positive technologies? Any thoughts about that?
For me, it will be availability of critical resources, virgin resources that go into low carbon technologies and stuff.
Okay, thank you. Carlota, have you had any thoughts about the book? Any thoughts about that? Or
Yes, I have. Speed and Scale.
Speed and Scale. And who's the author of that?
I think it's John Doerr, but don't quote me on that. It's basically a very well thought out action plan of how we get to net zero by a few of the industrial leaders with above bold ideas and propositions.
Okay, I'm just looking the book up. Speed and Scale by John Doerr. Okay, thank you very much. And on the group chat, on the conversation, Dr. Raj's email address will be appearing there, so you can email him for the discount on the book. Thank you very, very much, everybody. Thank you to our three guests this morning, Dr. Raj, Giorgio, and Carlota, and see you all again next week. Thank you very much indeed.
Thank you for having me.
Thank you.
Thank you.
Thank you. Thank you.